Hi there, welcome to Kneppy Invest. In this financial year 22 result video, we are going to be talking about Bapcor. Now, if you don't know anything about Bapcor, this is an automotive aftermarket parts distributor, particularly directly to specialists like mechanics. So Bapcor does have four segments, and one of those segments is trade. Another one of their segments is retail, and in the retail segment, they also selling or distributing parts and accessories, but that's more akin to people like me who are not specialists within the automotive sector. So they have Auto Barn, Auto Pro, Sprint, and Opposite Look. They also operate auto service centers under the Midas, ABS, and Shock Shop brands. Another two divisions they have include the specialist wholesale, and they also have the service division. They also have Bapcor New Zealand. Now, when I think about Bapcor and think about the short to medium term, I am neither bearish nor bullish about this company. But when I'm thinking about the long term, and when I'm talking about long term, I'm talking about 20 years from now, I'm probably a little bit bearish about this company moving forward, simply because of the increase in electric vehicles in our society. And when we do see a significant increase in electric vehicles in about 20 years' time, and it's going to be gradual, maybe it won't be gradual, but I think there will be an acceleration between about 10 and 20 years. And when we see that acceleration, Bapcor will be experiencing some headwinds unless they change their business model. But at this point in time, right now in 2023, I think the business model for Bapcor is okay. You're not going to get great returns in this company. You're not going to get awful returns in this company either. But just be aware of these fairly significant headwinds for this company in about 10 to 20 years. For full disclosure purposes, I'm going to start doing this now for every single video when I'm talking about individual company. I'm going to disclose if I hold these companies within my portfolio or I don't. So for Bapcor, I am a shareholder of this company right now. Now, I will probably call it a low conviction hold, and I am going through and changing the makeup of my portfolios. And this is one of the companies that I might sell out of if I come across better companies, and I am coming across better companies. But the question for those companies that I do think are higher quality than Bapcor, it's all about if I can buy those companies at better value. Not better value than Bapcor, but better value than they are right now. So I am a shareholder of Bapcor, but I might be selling out of this company within the next, say, 3 to 9 months. In saying all that, I would consider Bapcor to be a high quality company. Not the highest quality company you can find, but definitely not a low quality company. And in fact, Bapcor has been growing their revenue, their profits at a consistent basis over the past 8 years. I think this company listed on the ASX about 2014 or 15. So it hasn't been listed on the ASX for more than a decade. But during the time it has been listed, this company has been growing. And that's exactly what you want to see. Probably my only problem with Bapcor, apart from those long-term issues or potential issues, is just the growth. I would prefer a little bit stronger growth for this company. I'll talk about that during the rest of the video. One of the ways you could determine the quality of a company is just by looking at the long-term chart. And if we see the share price moving from the bottom left to the top right, that gives us a good indication that the company is pretty good quality, particularly over a 10-year period. Now, Bapcor listed on the ASX in 2014, so this is just a weekly chart for this company. We're going back to when they listed. Now, in 2015 and 16, the market was enamored with this company. And you can just see that with the share price appreciation. In fact, the share price went from under $2 to about $6.50 by the middle of 2016. Now, if you look at that share price high back in 2016, which was around about $6.50, and compared to the share price now, which is about $6.20, $6.30, the share price of this company has done absolutely nothing over the past 6 years. Now, that does not mean the company has done absolutely nothing, because the company has grown their financials. This company is more profitable. It's generating more revenue. The reason why the share price has gone sideways is because of multiple contraction or compression. So back in 2016, the P ratio of this company was around 40. Now it's less than 20. So just because a company can grow doesn't mean the share price is going to follow the growth of that company, particularly if the company was overvalued in the past. And I believe, in my opinion, Bapcor back in 2016 with a P ratio of about 40 was overvalued. And at that point in time, the market was willing to pay a premium for the company because the market thought there was going to be some significant growth in the future for this company. And to be honest with you, that significant growth hasn't really come. The company has grown, but not significantly like the market wanted. And that's why the share price has gone sideways over the last 6 years. Now on to the financial year 22 results for Bapcor. And at the end of trading on October 24, the share price of the company was $6.20, which means the market cap of Bapcor was $2.1 billion. Now on to the revenue, profit, or pro forma profit, and operating cash flow and free cash flow for the company. Revenue, $1.8 billion. And that revenue has been growing consistently over the past, well, since they listed on the ASX. We'll have a look at the revenue growth in the next slide. Pro forma profit, a little bit higher than normal profit, 132 million. Normal profit, if I remember correctly, was about 122 million. So pro forma profit has to do with acquisitions they have made, and they're just making the assumption if Bapcor had those acquisitions for the full financial year, the profit for the company would have been $132 million. Operating cash flow, 34.8 million, which is a little bit less than what they would have reported, because I do take into account leases, and this company has pretty high leases at this point in time. So that operating cash flow is a lot lower, and free cash flow only $6.8 million. And the reason why it's only $6.8 million and significantly lower than operating cash flow is because of capital expenditure. So it's very interesting to see how different the operating cash flow and the free cash flow are to profit. And that is one theme I want to explore during this video. Now to the revenue growth for Bapcor over the past 9 years, not since when they listed, because when a company does list on the ASX, they do provide at least 2 years of financial history. So they listed in 2014, and there was history for 2013, if I remember. But this is taken from Ticker, straight from Ticker. Now, these numbers are in Australian dollars, and you'll notice that revenue has consistently grown throughout the last 9 years, increasing from $306 million in 2013 to $1.8 billion in the most recent year. The other thing I've provided here is operating margins, and operating margins have improved consistently as well, but there has been some years where it fell significantly, and that was in 2020. So we'll just put that up to COVID-19. But we did see operating margins fall from 2021 to 2022. That does not mean there is a trend at stop. You might notice the compound annual growth rate in revenue is probably a little bit lower than what you would expect for a company that has grown their revenue from 306 million to 1.8 billion. And the reason behind that is because shares on issue have more than doubled for this company since they listed on the ASX. So those compound annual growth rate in revenue numbers are revenue per share. If you just looked at revenue growth, you'd get numbers around 15% per year since 2013. But since 2013, our revenue per share have only grown at 6.5%. Over the past 5 years, 7.1%, and over the past 3 years, 5.7%. So a lot of this revenue growth is because of acquisitions, not organic growth. Now, these numbers, these growth rates, I would like or prefer those growth rates in revenue per share to be a little bit higher or stronger than between about 5.7 and 7.1%. So that is one negative I do find about this company. Now, to looking at the financial statements for Bapcor, I'm only going to look at statement of cash flows and also look at note 26, which is the reconciliation of cash flows to the profit. I had a look at the balance sheet, and I always have a look at balance sheets and profit and loss statements. Usually I don't include those in videos. I might briefly mention the balance sheet because there were some interesting things in that, but I won't look at or focus on that in this video. Now, when I look at the statement of cash flows, there are a few things I want to see here, and that is receipts of customers. We already know receipts of customers or revenue did grow from last year, and receipts of customers did grow slightly, very slightly, in fact, from last year, increasing from 1.9 billion to 2 billion. You also note that operating cash flow fell from last year to this year, decreasing from 135.9 million to 104.8 million. Now, the thing I want to focus on here is trying to understand why the operating cash flow and the free cash flow was significantly lower than profits. You'll get some answers or possible answers in the statement of cash flow, but the most likely area or likely place you'll find those explanations are in note 26, which is the reconciliation of cash flow to profit. But there's a couple of interesting things in this particular statement of cash flows. So we had operating cash flow 104.8 million. They did purchase a business 20.6 million, but capital expenditure 43.6 million. not only was capital expenditure pretty high this year, it was pretty high last year. So this company does spend a lot of money on capital expenditure, and payment for intangibles, 13.8 million. There's also proceeds from disposal of property, plant, and equipment, 15.6 million. So I would exclude or minus that disposals of property, plant, and equipment, which is capital expenditure, from the payments for capital expenditure, which means all up about $28 million of capital expenditure, and net cash used in investing activities, 64.5 million. Not only that, dividends paid in the year, 71.3 million. So what I like to do is just compare the dividends paid to the operating cash flow. So there is a large proportion of the operating cash flow going back to the shareholders as dividends. Not only that, repayment of lease liabilities is really important for this company, and that is included in the financing activities. And that is why my calculated operating cash flow for this company is a lot lower, because of repayments of lease liabilities. This is a real operating cash flow, in my opinion. So that's why I minus that from the operating cash flow. So almost $70 million of repayment of lease liabilities. If you go back to last year, $61 million of repayment of lease liabilities. So this is an ongoing cost, and that's why I like to take that into account. But all up, if you don't include the net proceeds of borrowings, this company burned through a lot of cash. And you'll notice the net proceeds of borrowings was $143 million. So this company increased their debt by $143 million in financial year 22. And that would be concerning if I just focused on this and didn't look at anything else. This company was going into debt, and they're actually using debt to pay dividends to their shareholders and using that debt to repay lease liabilities. But that's not the end of the story. We do have to dig a little bit deeper. And to dig a little bit deeper, let's have a look at note 26. Note 26 is a reconciliation of profit after income tax to net cash from operating activities. Probably say and assume that most people wouldn't look at any of the notes, but they're there for a reason. And I really like these reconciliation of profit after income tax to operating cash flow, because this gives you some idea, some answers to why the profit for this company was significantly higher than the operating cash flow. So, well, in my calculated operating cash flow, for Bapcor's operating cash flow, there's not much difference. In fact, their operating cash flow was 104.8 million, their profit 125.6 million, but they don't take into account lease liabilities. I do take that into account. The first thing that really stood out here was depreciation amortization, $88.8 million this year, $85.4 million last year, and straight away that tells me Bapcor, for some reason or not, is a capital intensive business. So a lot of depreciation, a lot of amortization. Some of that amortization could be because of acquisitions they have made in the past. And in my opinion, this is just my opinion, a lot of amortization because of acquisitions in the past are not real. They're just there for accounting reasons. Anyway, that's a little bit of a rant gone. Anyway, a little bit of rant there. Anyway, the main thing I want to focus on here is changes in working capital, which is found in the change in operating assets and liabilities. And the main thing I want to see here is any increases in inventories and receivables or decreases in payables. And in fact, we have all three. And all three, if they are true, they are operating cash flow outflows. So you just think about inventories. If you really build up your inventories, that is a cash outflow, and could be a reason why the operating cash flow was lower than what you would expect or what you do see with a profit. And for Bapcor, their increase in inventories in the past year was 83.4 million. Last year it was 82.4 million. So this company has significantly increased the inventories that they do have in their stores. They also increase in trade and other receivables, 14.7 million. That is another cash outflow. And there was also a decrease in trade and other payables, and that's also a cash outflow. So all up, there was significant changes in working capital that can explain why the operating cash flow is probably lower than it probably should be, particularly when you compare it to profit. And that's not a bad thing. Now, in saying it's not a bad thing, it depends what happens with the inventories. Now, if Bapcor has way too much inventory and they have to sell that inventory at a discount, that's not a good thing. And I think a lot of companies, a lot of retail companies will find that out in the next year, because a lot of retail companies have built up their inventory because of supply issues. And I think those retail companies are going to find an issue. I'm not sure if Bapcor will find the same sort of issues Maybe they won't have to sell their stock for discounts because they'll just put it in the warehouse and just wait for that inventory to wash clean over the next few years. And if so, if that does happen, that would mean this company will be generating a lot of cash flow, a lot of positive cash flow in financial year 23 and possibly even into financial year 24. Now, to be fair, you didn't really have to go to the financial statements and look at note 26 to have an understanding what's happening with this business, particularly around inventories, because the company did describe it or explain it in their presentation. So if you don't look at companies' presentations when they release their financial results, I do highly suggest it. Not all presentations are good, but I find the majority of presentations will give you some insights into the running or the performance of the company. So this was found in Bapcor's presentation. And the first point here, they mentioned the increase in inventory. They call it an investment in inventory. Maybe that is a correct term, but cash conversion impacted by ongoing investment into inventory to mitigate global supply chain disruption risk expected to normalize in financial year 23. And I think there is a chance that this company will be flowing with cash in the next financial year. And hopefully they will, because their debt levels have increased by $140 million in the past year because of this increase in inventory. The other thing I like to see in any sort of financial statements, particularly if a company has a lot of segments, a lot of divisions, is how each division or segment is performing. And Bapcor provided that information. And this is straight from, I think this is from their notes in their financial statements. More than likely, the company would have provided this information in their presentation as well. And it would have been a little bit more clear, more clean, we'll say, because this is only financial year 22 numbers. You actually have to go to the next page to look at financial year 21 numbers. I would prefer a comparison between the two to see how each division has performed from last year to this year. And I would probably say that Bapcor actually did that in their presentation. Now, I'm not going to look at financial year 21 because if you do have a look at financial year 21 revenue for all these divisions, there wasn't much growth in any of the four. So we are looking at and comparing Bapcor Trade, Bapcor Specialist Wholesale, Bapcor Retail, and Bapcor New Zealand. On the top here, they give a brief definition or description of what each of these divisions actually do. So have a look at that. And I believe that was also found in the notes of their financial statements. So the main thing here I want to see is the margins of these divisions. So you can just compare the revenue to the EBITDA. I would prefer profit as well. And also the amount of revenue each division is providing. So by far, the two best divisions or segments are Bapcor Trade and Bapcor Specialist Wholesale. Coming up behind them is Bapcor Retail, and long way in the rear is Bapcor New Zealand. And actually, I won't say this, but the best in terms of margin division is Bapcor Trade. So EBITDA for Bapcor Trade is actually higher than for Bapcor Specialist Wholesale, even though revenue is a little bit smaller. So pretty good margins in Bapcor Retail as well, and pretty good margins as well in Bapcor New Zealand. So the main thing you want to see here is how each division has performed from last year to this year, and also focus on the margins of each division as well. And if one division or segment has significantly more margin or better margins than the other ones, then maybe the company and the management of the company should be focusing on that division in the future. Now onto the valuation metrics for Bapcor, and I always look at P ratio, price to sales ratio, which is not relevant for a lot of companies, and also price to operating cash flow. Also look at EV to operating cash flow, enterprise value to operating cash flow, which might be more relevant for Bapcor because they do have a little bit of debt and not as much cash. So in fact, the enterprise value would be a lot more than the market for this company. And that's probably more relevant for those companies that are really highly in debt now, or highly in cash also, because that means the enterprise value is significantly lower than the market cap. Now, I'm going to ignore price to operating cash flow because 60.3, and because of the build-up in the inventory, I don't think the operating cash flow or the free cash flow is a good way to judge the performance of this company in the past year. So we'll just focus on the P ratio for Bapcor. And in financial year, or at the end of financial year 22, the P ratio, well, actually, right now, the P ratio for this company is 15.9 because it changes every single time, every single day, every single minute, where the price of the company changes. So right now, at a share price of $6 $2.20, whatever it was. The PE ratio for Bapcor is 15.9, price to operating cash flow 60.3, which is absolutely ridiculous. Now, based off the earnings per share, I did a reverse DCF. I just wanted to see what the growth of this company has to be to justify the current valuation, and we get a number of 10.5% per year, which is maybe just a little bit higher than I probably would expect from this company. So you could argue, based off the reverse DCF and based off the historical growth of this company, there's probably not a lot of value right now in Bapcor, particularly if you are looking at a margin of safety. So if you're looking at a margin of safety and you want to buy this company, or you prefer to buy this company when it's ridiculously cheap, maybe a reverse DCF would give you, say, a 2% number or something. The share price of Bapcor would have to fall from here, or share price would have to go sideways and the profit would have to increase significantly over the next few years, which could happen because that's exactly what's happened to this company over the past 6 years. What I've done in this slide is just look at the historical operating cash flow, capital expenditure, and changes in working capital for Bapcor since 2013. A few things to note here. Now, I've already mentioned that Bapcor is a little bit more capital extensive than I thought, but in the past 2 years, I've only spent about $43 million in capital expenditure, which is not a number I would describe a capital intensive business as, but this company is a little bit more capital intensive than I would have assumed beforehand. And this is a really important point here. You shouldn't make assumptions about a company until you get the proof or the numbers behind those assumptions. So one of my assumptions about Bapcor was a little bit wrong in terms of capital expenditure. The other thing and very important thing to note here is operating cash flow. If you just focus on operating cash flow the last 3 years, you can see it has fallen from $200 million to $104.8 million. And that might be concerning for you if you entered the story or your research there. And then have you look at changes in working capital. It's actually gone from positive $32.2 million in 2020 to negative $120 million in 2022. So one of the things I like to do is to look at the cash flow from operations and then also add or subtract changes in working capital to that. So in 2020, if you subtract 32 million from 200, you have 170 million. But in the last 2 years, we add back that negative changes in working capital. So in 2021, you get a number of around about 218 million. And in the previous year, around about 220 million, which is better than what we would have seen in 2020. So always take into account changes in working capital. That's just my opinion. That's something I always do. Recently, the company did have an AGM and they did provide a trading update. And to be honest with you, nothing relevant in the trading update. I would have preferred some numbers, but a few statements were interesting. The first statement was around the good start in the first quarter of financial year 23, with both revenue and profit up compared to prior year, mostly driven by increased like-for-like sales. That last bit is quite important. I always look for like-for-like sales increase. But when they talk about revenue or profit up compared to prior year, what is that? What percentage up? Is it 0.1% or is it up 10%? And there's a big difference between 0.1% and 10%. And in my opinion, if revenue and profits were up 10% from prior year, they would have mentioned that. They would have said up 10%. So I'll probably be a little bit wary and suggest and assume that the revenues and profits are up minusculely compared to last year. And they also expect a solid underlying trading performance, whatever that means. What is solid? So all these non-quantitative words in here, which mean absolutely nothing to me. But anyway, solid underlying trading performance in financial year 23, subject to market conditions. So if financial year 23, we see those revenue and profit numbers go backward, they have a few excuses here, including currently elevated working capital levels expected to reduce during financial year 23, and trading will continue to benefit from positive fundamentals of the vehicle aftermarket. So some possible excuses if the company goes backwards in financial year 23. Now, this is a really interesting chart that I drew up myself, I used Guru Focus to look at the PE ratio history for Bapcor from 2016 to now. The reason I went back to 2016, remember the share price of Bapcor just went off the chart for about 2 years after it listed, increasing from about $2 to something like $7. Now, at the peak in the share price back in 2016, the PE ratio for Bapcor was 60, and that was a ridiculous valuation for this company. But the market was willing to pay a premium for Bapcor back then. But over time, the market is less and less willing to pay a premium for this company, and that's why the PE ratio has been falling. The only time the PE ratio has climbed, so there was some multiple expansion, was just after COVID-19. In fact, the PE ratio of this company went from a low of about 10 all the way to a high of 32. But from that high of 32, we saw towards the end of 2020, the PE ratio of this company has been gradually falling, which means we've gone through a period of multiple contraction or compression. And that's one of the reasons why, even though this company has increased their revenue, their profits over time, the share price has gone absolutely sideways since 2016, because the company has gone through a period of multiple compression. Now, this has happened to a lot of companies in the past. Probably the most famous case was Microsoft. For about a 15-year period, if I remember correctly, the share price went sideways because at the end of the tech bubble back in 1999, 2000, the PE ratio of Microsoft was like 72. And then the share price, after the initial fall during the tech bubble burst, share price of Microsoft just went sideways because it went through a period of multiple contraction. So even though the company grew its financials, so it went through financial expansion, the share price did absolutely nothing. So the best way, or the best companies to invest in, are those companies that go through periods of financial expansion and multiple expansion, because when you see that, that's when you're going to see the greatest returns for your holding. Now let's have a look at the Bapcor short-term chart, and this is the daily chart going back to August of last year. And to be honest with you, apart from a bit of a blip in the share price back in November, December last year, and that was around the CEO retiring. Not only did the CEO retire, I think he got put on the board. He wasn't fully retired, but then there was some issues. I can't remember what those issues were, but that's why the share price suddenly collapsed in November last year. In fact, the share price went from about $8.30 all the way to a low of $6.40. So the market didn't like that. Market does not like uncertainty. And when the CEO resigns or is fired, that's a lot of uncertainty. And that actually moved the Bapcor share price into a downtrend, and it fell all the way down to $5.50 in June of this year. Share price has rebounded, but I would not say the share price of Bapcor right now is in an uptrend or downtrend. It's really going sideways over the past 4 months. Now, I'm going to continue this financial year 22 video series over the next few weeks, maybe even the next few months. And the next 5 companies I'll be looking at include Prime Financial Group, Sims Metal Management, Pro Medicus and Super Retail Group, and Reliance Worldwide Corporation, which is relevant because Reliance Worldwide Corporation released a trading update on October 25, and the share price was down 13%. So without even looking at the trading update, it is a negative one, because that's what the market has done to Reliance Worldwide Corporation share price. It has absolutely punished it. But I might say and suggest that maybe Reliance is, and the valuation of Reliance is moving towards interesting levels because of the sell-off we've seen on October 25. So if you do have any suggestions of companies you'd like me to do a video on in regards to the financial year 22 results, just leave recommendation in the comment section of the video, and I'll see what I'm able to do. I would prefer the company to be profitable and also to be growing in regards to the revenue and profit. So that's all I have for looking at Bapcor's financial year 22 results. So even though I am an owner of this company, I would not call Bapcor one of the greatest companies on the ASX. It's a nice, good company that has been growing at a nice rate, but not a significant rate. And I'm looking for companies that can continue to grow at least 10% per year. And unfortunately, Bapcor is a little bit below that on a revenue per share basis. So if you have any questions, any thoughts, concerns, leave those in the comments section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.